Welcome back to Aurora Insights. Today we are talking with Chris Lowe about capital allocation, the share repurchase program, and what management's actions in the market are signaling to investors. All right, so in November 2025, the board approved a US 10 million share repurchase program, and you personally described Aurora Mobile's stock as substantially undervalued. Now, that is a bold public statement from a CEO, Chris. So what gave you the conviction, to say that? And what are you seeing in the business that the market is not yet pricing in?
When I look at what we accomplished in 2025, the first full year GAAP profit in company history, EngageLab reaching $10 million in ARR with 186% year-over-year growth. Q4 cash operating inflow the strongest since 2020 Q3, deferred revenue at a record high, a net dollar retention rate above 100%, and a 3-year cash balance increase of RMB 54 million without any capital raise. The operational fundamentals are clear. If the market had fully priced in those fundamentals, the stock price will reflect them. My saying substantially undervalued was not a promotional statement. It was a statement of my genuine assessment. The most credible way to back this view is through direct share repurchase. And that's exactly what we have done. As of December 31st, 2025, we can repurchase the 399,682 ADS under the approved program, including 72,598 ADS repurchased solely in Q4.
Wow. And share buybacks are often read, two ways by investors. Some see them, as a strong vote of confidence, and others, ask whether it signals the company has no better use for its capital. So, Chris, how do you respond to that second interpretation, given Aurora's active growth plans?
The second interpretation will only be valid if we were not simultaneously investing in growth. We established our Japan subsidiary in March 2026 with a dedicated local team and office. We launched the EngageLab Omni-Connect on ClubHub. We launched a model list in April 2026 as a new product line. We expanded EngageLab into 18 new countries in Q4 alone and now have 70 global partners. The cash position at RMB 173.4 million combined with operating cash generation means we can do all of these things without creating financial pressure. The buyback is funded from a position of strength, not from a choice between growth and capital return.
And like you just stated a little while ago, as of December 31st, 2025, you have repurchased 399,682 ADSs. So the program runs through December 2026 with US 10 million in capacity. So how do you approach the deployment? Is this opportunistic, systematic, or driven by a specific price target?
Primarily opportunistic. We do not have a fixed monthly schedule or mechanical rule that trigger repurchase at specific intervals. We assess where the stock is trading relatively to our internal assessment of intrinsic value, and we deploy capital when the gap between those two numbers is compelling. The repurchase program has a meaningful remaining capacity, and our commission about the gap between intrinsic and market cap has not changed. If anything, stronger Q4 result, the full year 2026 guidance, and the new product momentum from model list reinforce that view. The program assess precisely to act on those moments.
Right, and you are buying back stock while simultaneously investing in the Japan subsidiary EngageLab's international expansion and launching new products like Model X. So walk us through how you think about capital allocation across, that many competing priorities here.
Every capital decision goes through the same filters. Is this the highest return on invested resources available to us right now, including the option of returning capital to shareholders? The Japan story requires local team investment and office infrastructure, but is positioned to generate revenue from a market where we already had demonstrated product market fit. Model is a particularly interesting capital allocation example because the core infrastructure, the developer services expertise, the API reliability, the compliance environment, all of that already exists inside Aurora. The incremental investment to launch Model was modest relatively to the market opportunity. The ratio of incremental cost to addressable opportunity is how we evaluate every new initiative.
Yeah. And for a retail investor trying to understand Aurora's capital discipline, what is, the clearest evidence that management is allocating capital in a way that creates, long-term shareholder value rather than just, managing for short-term metrics?
The cash position increase of RMB 54 million in a year where we invest in Japan infrastructure, launch new product, expand their EngageLab internationally, and run a buyback program simultaneously. Any one of those activities individually will look like growth investment. All of them together, while still accumulating cash, tells you that the underlying business is generating more than it's spending. The second piece of evidence is that the dollar retention rate up 100%. That metric tells you we are not buying growth but by subsidizing customer acquisition. We are growing because customers who are already using our products are expanding their commitment. That's organic, high quality, cash efficient growth. When retention, expansion, and cash accumulation happen simultaneously, capital discipline is not just a stated priority, it's a document optional reality.
Yeah, well said there. And the combination of buybacks, new product launches, international expansion, and cash accumulation in the same fiscal period is a compelling picture of capital discipline. So thank you for that detail today.
Thank you, Aurora.